like to welcome everyone to the Pinnacle Point series webinar featuring Gary Stringer of Stringer Asset Management. I'm Todd Tyndall of Pinnacle Asset Management. This is Stacy Seeger as well, my associate. We're getting ready to get started. I want to thank everyone for joining us today on the call. Again, a couple of housekeeping items. We have muted everyone on the call today to make sure everyone has a good audio experience. Don't want a dog barking in the background if we can avoid it, typical Zoom issues. If you'd like to ask a question, please send it using the question and answer section on the right-hand side of the webinar, WebEx event screen. We'll capture your questions and share them with Gary. Today is going to be about 45 minutes to 1 hour. First of all, we're going to introduce Gary Stringer, talk about his bio real quickly. Gary will take that and discuss the markets in general for us and answer a lot of questions that we have gotten from many of our clients over time. Again, if you have a separate question you'd like that we don't cover, type it into the question and answers area. And then Gary will talk about his fund, his unique money management style, and then we'll also take Q&A at the very end. With that being said, I'll start with Gary's intro. Gary is a chartered financial analyst and is the president and chief investment officer for Stringer Asset Management. Gary talks about the power of marketing, of sitting down with many different types of marketing specialists to come up with all kinds of names for his firms, such as Phoenix and Zodiac and all the wild types of names. But at the end, unfortunately for Gary, being modest as he is, they said, name it Stringer Asset Management. So we have worked with Gary for many years at our former firm, Morgan Keegan, where he was a managing director and served as a director of investments for Morgan Keegan's Wealth Management Services division. At that time, Gary started a fund that was the early stages of Stringer Asset Management to manage restricted cash of advisors. So he had some under the most scrutinized investment choices for very informed clients that morphed into this particular fund. He holds a Bachelor of Science degree from the University of Maryland, as well as a Chartered Financial Analyst designation, and he's a member of the CFA Society of Memphis. He also went to some school called Wharton School of Business. I don't think I always tease Gary, I don't think they're in the SEC. They must be an ACC school, but a proud graduate of Wharton. Gary holds various industry accolades and is a frequent speaker on both our financial networks as well as publications. With that being said, I am delighted to introduce Gary Stringer to our Pinnacle clients and Pinnacle bankers. Welcome, Gary Stringer.
Thanks, Todd, and thanks everyone for joining us today. If we could set up so I could share the screen, I can run through these slides, some of these graphs. But while that's being set up, we can talk a little bit about why we're here, why we do what we do. As Todd mentioned, we have worked together for a number of years with financial advisors and their clients as we try to help people just do better in the financial markets and better achieve their goals. So really, the driving force behind everything that we do is we're just trying to be a great partner and help people do better, especially with the complexities of reaching financial goals in this ever-changing world. And so we think about in terms of behavioral finance and helping investors do better by avoiding some of the behavioral finance pitfalls, and that involves a lot of active risk management. So when we talk about our strategies and what we're doing, we always talk about manage the risks and let the returns take care of themselves. That helps in a number of different ways, including just smoothing the ride and helping people sleep at night. And that's really what's behind everything that we do. So we're going to run through briefly our outlook on the economy and how that translates to what we see in terms of opportunities and risks in the financial markets. This first graphic here is the historical US GDP, gross domestic product, by calendar year. The green bar all the way to the right is our forecast for 2021. You can see the long-term average going back to 1980, all the way up to where we are today, and is the dotted line there. And we expect US economic growth to be about 7% this year, which would be the fastest pace of economic growth in the United States since 1984. So you have to go back almost 40 years to see a setup this optimistic for economic growth in the US. And we'll talk a little bit about why we think that's the case. Why are we so optimistic? This graphic here is the Purchasing Manager Indices, the history. We economically weight these indicators to emphasize the service side of our economy. As the economy has evolved over the years, it's become much more of a service-based economy. And what we're looking for here is, what we're comparing here is the 3-month moving average for the Purchasing Manager Index. So this is a measure of business growth or economic growth. And we compare the 3-month to the 12-month. So if the 3-month, the near term, is higher than 12-month, we can say that the economy is accelerating. If it was lower than the 12-month, you would expect the economic growth to be decelerating. And what you can see all the way to the right is that the economy is absolutely set to accelerate the pace of growth as we move forward here. This is a very optimistic sign, a survey strictly from the business side of the U.S. economy and emphasizing the service sector. So this is about as optimistic as we've seen this chart, as you can see. Another reason for optimism is simply the vaccine distribution has been, we've seen it decelerate here recently from about 3 million average shots a day to about 2 million, but still at this pace, the United States will reach close to herd immunity in the next 3 to 4 months, so sometime over this summer. And for an economy this size, the population this large, to have a distribution on pace here is really stunning and in a very positive way. So we're very optimistic about the way things are lining up with respect to vaccine distribution, because as more people get vaccinated, that allows for, as you've seen, these restrictions to be dropped and the economy to reopen. And so when we think about reopening, we also think about the jobs picture. The more people we have working, the more consumers we have, the more people are going to be spending and be optimistic about things. And we've seen a pretty strong rebound in employment over time. Last month's April report was a little bit disappointing, and there's some factors for that. But we're actually quite optimistic over the coming year or so to get back to pre-trend labor force growth. And so, for example, during the previous business cycle, the U.S. economy created almost 200,000. It's actually 188,000 new jobs per month. We actually expect, our work suggests that we'll get back to that pace, that pre-pandemic pace, in about a year or so, or over the next year or so. So we're likely to see about over 9 million jobs created over the next 12 months or so. So we expect a pretty strong pace of labor force growth. More people working, being more productive, clearly is pretty strong for the economy. Another thing we want to consider is household net worth. And this is really interesting. So this is assets less liabilities at the household level. And we're expecting to see a very different recovery than what we saw during the last recovery from the global financial crisis. It took a long time for the economy to recover in that period because it was a different kind of shock to the economic system. And in fact, here we can see, just by looking at household net worth, recovering from the global financial crisis, it took about 5 years for household net worth to recover from the pre-crisis peak in 2007 at 70.9 trillion. It took 5 years to recover to that. This most recent crisis, it took less than 3 months for household net worth to recover. And in fact, we're at an all-time high for household net worth in the United States. And that's with, remember, that's with all the unemployment that we just looked at. You know, we need about 9.2 million new jobs to get back to trend. And even with those relatively large number of unemployed, household net worth is at an all-time high. So you end up with a situation, and this is largely because of the sector of the labor force that was most dramatically affected, which would be, for example, hospitality and leisure, that sector. Also, the nature of the decline. Remember, the financial crisis was more of a balance sheet recession, and it took a long time for households to repair their balance sheets. In this particular case, it wasn't nearly anything like that. So you've got very strong economic growth, as we can see in the PMIs and that economic momentum. Significant labor force slack still, so an opportunity to put people to work. Yet even with that labor force slack, you have all-time high household net worth. And so as the economy reopens, we know that U.S. consumers like to spend. And just because you maybe didn't take a vacation last year doesn't mean you'll take 2 vacations this year. But we do expect consumer spending to continue to increase. In general, in fact, Home Depot just had a blowout earnings report this morning. We expect these kinds of businesses, the reopening theme, to be with us for the next 12 to 18 months. Very optimistic in that regard. So we are at the front end of a new economic business cycle with an awful lot of momentum, an awful lot of power to drive this economy forward. If it's business optimism, even businesses are flush with cash today in aggregate. Now, some businesses are clearly still struggling, but in aggregate, businesses are flush with cash. Some households are still struggling, of course, those, especially in the hospitality and leisure space, but in aggregate, households are flush with cash. So we're at the front end of an economic cycle. And this has real implications for things like the pace of economic growth, interest rates, inflation, et cetera. And what we're looking at here is the yield curve in the U.S. Going back to the early 1980s. It's the 10-year compared to the 10-year Treasury yield compared to the 1-year Treasury yield. And as you can see historically, at the beginning of a new business cycle, the yield curve increases. So the difference between the 10-year Treasury yield and the 1-year increases to well over 2%, oftentimes 3% or more. And given the nature of the short-term interest rates today, where we think the Federal Reserve will keep the short end of the yield curve, so short-term interest rates pegged near zero for some time, we think that we should expect to see the 10-year Treasury yield rise to near 3% or more. So it might not hit 3%, it might be 2.75 or something in that range, but significantly higher than where we stand today. So our base, this would not be an outlier either. I know a lot of forecasters are saying maybe a 2% or 2.25%, something like that Treasury yield. We think that's more the outlier. A 3% Treasury yield is actually, as you can see, completely consistent with respect to the yield slope of the yield curve, the long-term interest rates minus the short-term interest rates, completely consistent with history. Further, there's a relationship between the pace of economic growth in the U.S. and long-term interest rates. So even if you look at it that way, if we're talking about the pace of economic growth accelerating and remaining strong for the next couple of years, that's another way to look at it. That gets you to a very similar result. So with respect to what our thoughts on interest rates and the fixed income markets, for now, we're quite defensive. We want to protect because as interest rates rise, bond prices tend to fall. Bond prices do fall, especially long-term interest rates, long duration bonds. And but on the other side of this, we're actually quite optimistic and excited to be able to, in 12 or 15 months, whatever that's going to be able to go out and buy 10-year Treasury bonds at something closer to 3%. So for now, it's defensive there, pretty optimistic going forward. This last piece is the cash indicator, which we're quite known for. This is a quantitative tool that shows us liquidity stress in the market. And what we think about here is we were just talking about some of the fundamental factors, like the business surveys, household net worth, the potential for labor force growth. This is a quantitative tool, the cash indicator, that looks at panic and fear in equity markets and in credit markets. And the idea is that there are points in time when the markets themselves can break down. And this happens when you have a real liquidity crunch, when there's basically a boycott of buyers, and there's only sellers in the market, and prices fluctuate significantly and tend to plummet. So what we can see here is it's on a scale. The median long-term number for the cash indicator going back to 1986 is 28. And if it goes too high, that's a signal to raise cash. You can see those red bars there. If it gets too low, it suggests that the markets are overly complacent. And it's done a really nice job of distinguishing what is typical equity market volatility. Anytime we're talking about the equity markets, we should expect some level of volatility. It tends to come right back. It helps us differentiate between what is typical equity market volatility and something that can be much more significant. And it's a very stubborn indicator. We talk at it, the analogy is sort of like the airbag in your car. You hope it never goes off, right? But you sure are glad that it's there to protect you in case it does. And this is the third layer of our risk management approach. And the cash indicator, as you can see today, or most recently as of the end of April, was at 18. So it is below the median, not quite so low that the markets we believe are overly complacent, but far from anything that we would consider crisis type levels. So we have a strong fundamental backdrop. Yes, the economy or the stock market may be due for a bit of a pullback in here, but we wouldn't expect anything too significant. You might see a correction. In fact, on average, the U.S. equity market tends to go through what they call correction, quote unquote, which is a decline of at least 10%. Happens roughly every 18 months, and then it tends to bounce right back. Those types of things we manage for as well, but this is specifically looking for something much more significant, like we saw last year, for example, during the pandemic economic shutdown and liquidity crunch resulting from that. But we're not anywhere close to something like that today. So when we look at all these things together, the fundamental backdrop, as we look at, again, our 3 layers of risk management for what we do with our strategies, people are looking for us to provide a consistent result. The folks that use us where we tend to fit well with investors are for folks who have already established some level of wealth and are looking for a reasonable rate of return without subjecting themselves to undue risk. And so that risk management, that behavioral finance, risk-first approach is pervasive in everything that we do, and that leads to our 3 layers of risk management. A lot of what we were talking about today was the more the tactical component, but the first layer is the strategic view, our 3 to 5 year outlook, which includes where we think valuations are today in stocks and bonds. Our tactical view, which is, as we just discussed, is actually quite optimistic for the next 12 to 18 months, especially for the U.S. economy. If things were to change, if some of these indicators that we track were to shift in a more negative and less optimistic direction, we would tactically play more defense in our portfolios. So backing off equity sensitivity, maybe hold some more defensive equities and even start to allocate to some cash. And then finally, the third layer of risk management is the cash indicator. This is kind of your sleep at night and plan in case of emergency. And if the cash indicator were to go off and we monitor it in real time, we would raise at least 20% cash coming out of the equity side of the portfolio. And over time, these 3 components together, these 3 layers of risk management and that risk-first approach has led to long-term results that have been market meeting or beating with 10 to 20% less risk. So a much smoother ride than what the markets have provided historically. And that's really what we're trying to do to help people do better at achieving their goals. Their financial goals, having to be a good partner in that journey is to help smooth the ride for people. So we don't have so much volatility, so much downside. If we can protect help people sleep at night, that goes a long way to helping people achieve long-term success. And then of course we have all the disclosures for folks to read in your spare time. And with that, Todd, that was the prepared part of the presentation that we had.
Excellent. Thank you, Gary. We've had this conversation before. You and I have known each other quite some time, but we've been at this for 30 plus years. And when I see the speculation in the market and the explosion of not what I would call not real assets, but different types of speculative types of assets and the turn to speculative investing, I start getting a little nervous. I start, when everybody in the world is asking me about Bitcoin and other types of investments that have exploded, then I start getting extremely nervous. But what's different about this market, I believe, is one, you still have such a high, and a lot of our people we trust have such a high sense of optimism going forward for the next 12 to 18 months in the market. It makes me have to be even more patient with you in that regard, waiting on the other shoe to drop. And how does that make you feel, knowing that you're seeing all that speculation out there? Is there other areas we're missing, or what do you think?
That's a really great question, and you're right. There is an awful lot of speculation in the markets. If it's the Bitcoins of the world or some of these GameStop or some of these other areas that we've just seen crazy valuations. And meanwhile, there are other areas that have been basically ignored. And so there's really good, even in the equity markets at these levels, we think there's great valuations in areas like, for example, healthcare. The healthcare sector in the U.S. stock market, we think is actually one of the least expensive, so one of the most inexpensive sectors in the U.S. equity space. So that's one of the areas that we favor. Banks and energy. These two areas have done well recently, but we think there's a lot more left in the tank here, especially as the economy continues to accelerate. Interest rates move in a favorable direction for the banks. We think that's an excellent place to be. And the energy sector, there is some volatility, of course, with energy prices, but we are pretty optimistic about these areas as well. So we think there's a lot of opportunity out there. And if we could just avoid some of these things that are so speculative, this is really our kind of market. It makes a lot of sense to us. And yes, we should expect volatility. You know, maybe the equity market might be due for a pullback, but we don't see anything that's more significant than maybe a correction in here. And it's unless things change fundamentally or the cash indicator shows us those kinds of dips are buying opportunities, especially in these areas like healthcare, banks, and energy.
Well, let's dive into banks for just a minute. I know a few bankers out there, and why is this such a great environment to the layman for banks going forward?
A couple of things. Banks in aggregate have very strong balance sheets right now, especially in the United States, and they have, because of the strength of their balance sheets, a great capacity to lend. And with what we see in terms of interest rates, our forecast for interest rates, so the net interest margin, the difference between what their cost of funds and what they can lend at, becomes much more interesting than it's been in a long time. So we think there's a lot of potential there. We expect loan demand to increase. So businesses are flush with cash, so that makes some sense why that might be a headwind to loan demand in the near term. But as this economic cycle extends, we expect to see really good things, earnings reports from the banks going forward.
The last time we had serious inflation, I think I might have been 15 or 16. I was kind of thinking of my next, my first car more than inflation. But I know the adults around me were extremely nervous about it. But we do seem to have some potential inflation headed our way. Do you see extreme inflation, or do you tell us what your thoughts are about that realm real quick?
Yes, absolutely. We do think we're going to see more inflation. In fact, we expect over the next 12 to 18 months to see more sustained inflation than the Federal Reserve currently forecasts. The next couple of months are going to be tricky because of the year-over-year comparisons. We saw a big inflation report just last week of more than 4% year over year. We expect to see another couple of months of that because, again, a year ago, we were in the lockdown in a deflationary environment where gasoline prices were plummeting, prices of all manner of goods were plummeting at that time. And so when you go from a lockdown like that to just basic economic growth, you're going to have year-over-year comparisons are a little bit weird and quite volatile and extreme. So we should expect that for the next couple of months, but then things will tend to smooth out. But we think with inflation over the next couple of years settles in at a rate that is higher than what the Federal Reserve expects at this point, partly because economic growth we think will remain high and strong. Inflationary pressures like higher wages will be passed through. So we do expect somewhat higher inflation, but not what we saw in the 1970s. The 1970s was a very different environment, and a lot of that was due to just the devaluation of the US dollar versus other assets and other currencies. And we just don't see that in this environment. We actually think the US dollar, at least for the next 12 to 18 months, will likely strengthen, which is one of the reasons that inflation won't, we think, break out.
A lot of our businesses that we work closely with have two major issues on their mind that they're running into. Supply, number one. We had a stat of interest just the other day that lumber alone had increased by over 300%, which is an interesting factor, but also hiring as well. A lot of people feel like the government assistance may keep the workforce limited for a period of time. Do you see that as a long-term trend as far as supply, which is important, and hiring? Can you kind of give us some thoughts on both of those issues?
Sure. Yeah, we are definitely seeing some supply bottlenecks in terms of materials like lumber, for example, and semiconductors and these types of things where you've got automobile manufacturing being pared back because there aren't enough semiconductors to meet demand. But one of the beautiful things about this economy is that price does an awful lot for you. As prices move higher, suddenly more supply shows up to reach new equilibrium. And in fact, that's what we expect. For example, lumber prices are very high, but we expect them to remain high for some period of time, but they'll likely come down as new supply meets demand. For example, you're likely to see more lumber imports from Canada as a result of the more attractive prices in the U.S. versus what they can get for lumber in Canada. So you'll likely see these kinds of things work themselves out. Similar with the semiconductor issue, that might take a little bit longer because of the manufacturing behind it. But over time, these bottlenecks will get worked out. With respect to the labor force issues, there are probably several issues that feed into the April disappointing jobs report. But with respect to factoring in a couple of things, there's still some areas that are slower to open. There still is some hesitancy for people going back to work. There still have some issues with, for example, people having to stay home and can't go to work because their kids are home. These types of things. But as the vaccines get more broadly distributed and schools go back to more what would be closer to historical norms, some of those factors lighten up. And around the same time, in September, the extra unemployment benefit that comes from the federal government goes away. And so you have a lot of these things occurring over the next few months. And so we actually expect to see much more jobs growth coming in the next few months and getting back up to something that would be more akin to 900,000 to 1 million new jobs per month, probably by the fall, as a lot of these things subside.
Yeah, it's such an oddity to come out of a recession, a quote recession, and see businesses begging to hire individuals, as opposed to most recessions we've seen where there is no hiring in that particular regard. So
Right.
this COVID recession is such a different animal compared to others. And I think it's going to be one for the history books about all the interesting factors that are different from other recessions. I worry that we compare this to other recessions, and it's more of seems to be more of a one-off than a true recession. Any thoughts on that?
Absolutely. And we completely agree with you. We started seeing this last May, so about a year ago now, where some of our most sensitive leading economic indicators were making a sharp V-shaped recovery, and led us to believe that when this recession is actually in the history books, it'll likely be counted as the shortest recession in U.S. history, going back to the 1850s when they started keeping these records. We think the recession actually lasted about 2 months. We'll see what the official acknowledgement is of that, but it is a very unique environment where you literally have the government turn off the economy as if you turn off a light switch. And then as things got better, it turned back on the economy and off we go to the races. So it is highly unusual, not just in the formation of that, but also the massive government support that we've seen, with the Federal Reserve within about 3 weeks injecting as much liquidity as it took them about 18 months during the global financial crisis. And on the fiscal side, you had a bigger fiscal response. It's probably going to be the biggest fiscal response in the history of the United States, bigger than the fiscal support that the U.S. government offered during the entirety of World War II. World War II is almost 4 years long, and we've ingested, the federal government has injected more liquidity in the economy today, or more money, than they did during the entirety of that war.
Well, with that being said, the yin and the yang of things, with us injecting so much liquidity, certainly a concern for future generations is going to be the debt side of that particular scenario. Are we crippling ourselves with debt for future generations? Your thoughts on that, please.
Yeah, so No, we don't believe we are. I think at this point, to where we've gotten to today, when you're in a battle and the bullets start flying, it was good that the government stepped in aggressively. Had we not, we might still be struggling like some other economies around the world continue to struggle, partly because of the lesser fiscal response and monetary response from our central bank versus others. And when we look at the level of interest rates, even as we think about it, with getting up to maybe a 10-year Treasury yield, that's still low by historical comparisons. And so when we think about the ability to service the debt as the economy continues to grow, we'll still be in good shape. It's really a challenge for us when we think about things on a go-forward basis. If the government on the other side of this crisis, I think Winston Churchill said, never waste a good crisis. On the other side of this crisis, as this crisis abates, can they restore fiscal responsibility going forward? So, for example, historically, the U.S., up until this crisis, on average for the last 50 years, the U.S. ran an average deficit, federal government deficit, of just under 3% per year. Yet our tax base, so our ability to service that debt, grew at a faster pace. So we were able to maintain, and that was okay. If we can get back to that, we don't need to necessarily balance the budget. Just get back to good old-fashioned 3% historical deficits. The economic growth is such that we'll be able to pay down that debt to a more reasonable level over the next, and it won't be a couple of years, it'll be a decade or more to get it back down. But we'll be on a very positive trajectory, which is very different than other countries. A classic example was Greece when they had to default on their debt. They called it restructuring because that's what it's a polite way for politicians to frame a default. But their economic growth was not anywhere near enough to service the debt. Their debt burden was growing much faster than their economy was growing, and they could never catch up. And so they had to, quote unquote, restructure. In the US, we don't have that problem. The fundamentals of the US economy are still quite strong because we have an advantage that a lot of countries don't have. We have the growth, the two primary drivers of long-term economic growth are the growth rate of your labor force and the productivity growth of that labor force, which is largely driven by innovation. In the United States, our labor force growth rate has declined over the decades, but it's still quite positive, especially relative to other countries. And our productivity growth, because there's so much innovation in our economy, and innovation is what really drives productivity growth, we have both these factors on our side. And so actually the long-term economic growth prospects for the U.S. are really quite positive.
That is comforting to know we can basically work our way out of this. How about, let's talk about tax. It seems like our tax bill may be larger going forward. Is that going to be exorbitantly larger, or what's your thoughts on that particular situation?
Yeah, so it's pretty clear that taxes are likely to increase both on the corporate side and at the individual level. If we talk first about the corporate side, on the campaign trail, President Biden was talking about a 28% corporate tax rate, and now they're talking about negotiating it down to something like in the mid-20s. And we're very likely to see higher tax rates than where they are today in the corporate side. But because of the nature of the mixed government, meaning that though the Democrats do technically have control of both the House and the Senate, their control of the Senate is very, very slim, and they need to have all the Democrats on board to get any of this stuff passed. And you have some Democrats that are quite conservative or moderates that aren't on board with some of these big tax hikes, like Senator Manchin out of West Virginia. So that's where you get into something like a 25 or 26% tax on business, which isn't great, right, for profits, and it's not probably great for stock market valuations because that's less money to share with the shareholders after that. But even at a 25% or 26% marginal rate, that's significantly less than the 35% effective tax rate that we saw in the 1990s on large U.S. companies. And the 1990s were a great time for the economy and for stocks. So we don't think that that level of tax rate on the corporate side is going to be such a burden as to create a massive headwind. Where the personal side, the individual side ends up is is even more uncertain. There's a lot of different ideas being kicked around. But again, the Democrats can't afford to lose a single vote in the Senate to get any of this passed. So some of these things that are more extreme, that catch a lot of headlines, we really don't see coming down to reality because they won't be able to get through the Senate.
Excellent. With that being said, I'd kind of like to spend just a minute talking about your fund and the uniqueness of your portfolio. The way I understand your portfolio, we have a traditional side where you will allocate monies to large companies, mid-sized companies, small companies, international exposure, and different aspects of the bond market. But also there is an overlay where you can go over and overweight areas of interest, sectors of interest, whether it be technology. You mentioned energy is one, healthcare, things of that particular nature. And then uniqueness, the behavioral science side of your portfolio, which I refer to the flashing yellow light, or as an analogy that some people remember and some people I had to explain to, the canary in the coal mine. Some of the younger generation may not understand that analogy, but back in the day, in coal mines, to make sure the air was good, they would have a canary in a cage. And unfortunately, if the canary died, you knew to get the heck out of that particular coal mine. So your cash indicator to me is the canary in the coal mine. And it's helped us on numerous occasions with not only your portfolio, but other portfolios and for many clients. Just a perfect example was in December of 2018, from the 1st of December to the day before Christmas, the market threw a serious temper tantrum because they were basically tired of interest rates going up. And the Fed had predicted for the next year, for 2019, that they were going to go up at least 4 more times at that time. To my knowledge, at that particular time, your cash indicator got up around about 35. My clients, particularly one of my endowment clients, was asking, should we go to cash at this time? And we were able to tell them, no, the cash indicator would go to cash at 25%, around 50 to 55 range. And then certainly 50% cash, like we did in 2008, 2009, at 100 on your indicator. So we were able to tell a lot of our clients that no need to go to cash. The indicator shows us that we need to stay in the market, which a lot of our listeners have many different portfolios, but the ability to say, here's a cautionary light going off and should we go to cash or not with your unique cash indicator is a blessing to our investors. It has helped us make the right move at the right time on a lot of instances. So if you can kind of explain a little bit about your portfolio, and then also maybe use the perfect example of what happened first quarter of 2020 in regards to the canary in the coal mine or the cash indicator for us, please. Thank you.
Sure. Yeah, it really does get back to your point about helping people stay the course. Markets can be quite emotional, right? And that volatility makes investors emotional. In fact, behavioral finance teaches us that downside volatility affects us at least twice as much as euphoria of gain. So if the market's down 2%, it feels twice as bad as if it was up 2%. And when you have these shocks like we had at the end of 2018, it really sends a shiver down people's spines, and you're wondering what's going to happen next. And so it's important to have these 3 layers of risk management, these tools in place ahead of time, so that we have a context through which we can view the world. And an example would be last year, for example, coming into March, some of our more sensitive leading indicators that help us with our tactical positioning were suggesting trouble ahead. Now, we weren't making the call that the government's going to shut down the economy, but even without that, some of these things were looking choppy. And so we started to hold a little bit more cash coming into March. And in fact, in our equity allocation. We were at about 15% cash in March of last year, so protecting in that regard as the markets were slipping. And then the cash indicator went off and suggested that we would take it to 25% cash. And so it was an incremental shift to go from the 15 or so percent cash that we were holding in our equity allocation to the 25%. But that significantly helped. During that period of time, we outperformed the global equity market by more than 5% during that period. And then quickly, as the Federal Reserve showed up with this massive amount of support, some of our, again, most sensitive leading indicators started to point in a positive direction. So we were able to quickly, because this was, as you pointed out earlier, a very different kind of scenario than we've seen in the past, where things tend to last a lot longer with respect to the length of a recession and the duration of a market decline. And because these tools told us that, hey, things are getting better rather quickly, we were able to start reinvesting those proceeds on the 1st of April. So we were quickly getting back to work with respect to what the markets were doing. So that one of the unique things about this process is that many other purely quantitative ways of raising cash actually stayed in cash until the summertime, until into June and July, and missed a big part of that rebound. This methodology allowed us to get back to work in April and catch much more of that upside. So
great indicator.
Mm-hmm.
Yeah, I mean, for example, like you said, a behavioral indicator that helps. As we always tell our clients, if you get out, you got to make two decisions: when to get out, and the tougher one, when to get back in. You do that for clients. Obviously, first quarter of 2020, the perfect example. You're out in late March, you're back in 1st of April. The significant moves between the end of March to the 1st of April is anywhere from 30 to 50% change in market value for clients. If you want to see that, ask any of your advisors to look at your portfolio from the end of March 2020 to the 1st of March of 2021. You'll be astounded at the reversal in the numbers. But again, I love the behavioral side of your portfolios, and certainly a very nice addition to most of our clientele's portfolios in that particular regard. Gary, I'm looking on here. I think we have hit most everyone's question. So I think we have the ability to say goodbye and thank you as always for your enlightenment, your knowledge, and certainly your support of us and Pinnacle Asset Management and the bankers at Pinnacle and our wonderful clientele. So with that, I think we are able to conclude our seminar today. And again, from the bottom of our heart, thank you to all our Pinnacle clients and certainly to our hardworking Pinnacle bankers. Thank you, Gary, and thanks to all.